When the stock market drops, seasoned investors see opportunity instead of panic. They understand that market downturns are part of the cycle and use these moments to buy valuable stocks at lower prices. Rather than focusing on short-term losses, they stay committed to their long-term goals, trusting the market's potential to recover and grow. This video explains how to view downturns as a chance to strengthen your portfolio for long-term gains. Welcome to holisticinvestment.in. Market downturn, the perfect time to build wealth. In India's fast-growing economy and stock market, using downturns as buying opportunities can be a powerful wealth strategy. Buying low has long proven successful for long-term investors, but just how effective is this approach? Does it guarantee profit? To understand the potential of this strategy, let's look back at historical data. When market falls, strategies like buying low, selling high, and investing in strong stocks or mutual funds can lead to substantial gains. Long-term investors often benefit from market recovery and growth following declines. Next, understanding market cycles. Stock markets move in cycles. After a peak, it's normal to see pullbacks triggered by factors like inflation, geopolitical issues, or financial crisis. However, these downturns are usually short-lived. As economic conditions stabilize, markets often rebound and continue upward. Investors who understand these cycles and act wisely during declines often achieve higher returns than those who panic. Isn't it true that those who stay calm in correction tend to see better results? Indian markets, including indices like Sensex and Nifty, have faced numerous downturns and rebounded each time. Investors who made smart choices during these lows have been rewarded significantly. Next, Indian stock market, a story of declines and comebacks. Like other global markets, the Indian stock market has faced substantial downturns over the years. Yet each decline has been followed by a strong recovery, rewarding those who stayed invested. But what drives these market crashes? Are they random, or do specific factors like global financial crisis or policy shifts play a role? Let's examine a few notable declines and see how the market managed to bounce back each time. The 2008 crash, global financial crisis, hits India. The 2008 global financial meltdown, triggered by the US housing crisis and banking failures, led to one of the most severe market declines. In the early 2008, the Sensex was at a historic high of 20,827, but dropped to 8,000 by October, a 60% drop. The Nifty also fell sharply from 6,200 to below 2,500. Panic set in and many investors exited, locking in losses. Despite the plunge, the recovery was swift. Central banks took action to stabilize the global financial system, and by late 2010, the Sensex surpassed its previous high, rewarding those who stayed invested or bought during the lows. Lesson learned. Investing during market dips can lead to significant long-term gains. Next, European debt crisis 2011. The 2011 European debt crisis led to volatility across global markets, including India. The Sensex fell from 21,000 to below 16,000 and Nifty dropped significantly. However, with the European Central Bank's intervention, markets rebounded, and by early 2013, Indian indices had recovered to previous highs. Lesson learned. Temporary global disruptions may impact markets, but patience often pays off. Next, demonetization 2016. In November 2016, India demonetized 500 rupees and 1000 rupees notes, affecting 86% of the currency in circulation. The Sensex and Nifty saw an 8% decline as sectors reliant on cash were impacted. However, by the end of 2017, the Sensex had surged past 34,000, a 28% increase from the lows. Lesson learnt. Short-term policy disruptions can create temporary dips, but may present buying opportunities for long-term investors. Next, COVID-19 pandemic 2020. In early 2020, the COVID-19 pandemic disrupted economies worldwide. India's Nifty 50 dropped from 12,000 to 7,500 points by March, a 40% drop, while the Sensex fell by over 35%. With the economies on hold, panic selling continued. However, global stimulus measures helped the market rebound, and by mid-2021, both indices had not only recovered but reached new highs. Lesson learned. The COVID-19 COVID-19 crisis demonstrated the resilience of markets. Investors who remained invested or added to their portfolio during their lows were rewarded as the market rebounded. Next, let's take a look at the year-on-year performance of Nifty 50 index from 2007 to 2023. Yearly market dips offer opportunities. Historical data shows that the Indian stock market typically experiences annual declines of 10 to 15%. By investing during these dips, investors can often benefit from substantial gains when the market recovers. Key takeaway: patience and resilience during downturns can transform temporary setbacks into significant growth opportunities. Next, long-term gains. Historical declines in the Indian stock market show that despite facing occasional setbacks from global and economic events, the market has consistently rebounded. Every downturn has been followed by a strong recovery, rewarding investors who took advantage of these dips. Understanding the benefits of investing during the market declines can boost confidence and encourage more strategic, well-timed investment. Next, compounded growth over the long term. One of the most powerful advantages of long-term investment is compounding, earning returns on returns, similar to interest on interest. The longer you stay invested, the stronger the effect of compounding becomes. For those who invest strategically during downturns, the compounded growth potential is even greater as the market recovers and continues to grow. Next, big one-day drops, prime investment days. The Indian stock market occasionally experiences a single-day drop of 5 to 10%, which often turn into great buying opportunities. Here, some of the biggest one-day falls in Sensex along with the reason for these declines. Next, rupee cost averaging, a smart strategy in volatile markets. Predicting market movements during volatile times can be difficult. So, how can investors navigate these swings? A reliable approach is rupee cost averaging in equity-based mutual funds. Rupee cost averaging involves investing a fixed amount regularly regardless of market conditions. When the net asset value is low, more units are purchased, and when it is high, fewer units are bought. This strategy effectively reduces the average cost per unit over time. Rupee cost averaging works especially well during downturns, allowing investors to buy more units at lower prices and setting the stage for future growth. Next, psychological benefits, building resilience during market downturns. Investors who successfully navigate market declines often gain greater confidence in their investment decisions and a reduced inclination towards emotional reactions. It is a mindset that fosters sustained wealth building over time. Why do sharp market declines spark so much anxiety? While it's natural to feel uneasy, history and data show that real potential for gains lies in disciplined investing during these times. Can we stay focused despite short-term turbulence? Maintaining a long-term perspective is essential. Investing in market downturns not only reduces the impact of market volatility but allows investors to acquire valuable assets at lower prices, setting the stage for wealth growth over time. Stock market returns. What should you expect? The Indian stock market can be volatile in short term with frequent ups and downs. But what about the long run? Historically, it has delivered average annual return of around 10 to 15% over extended periods. Examining any 5-year period, the market tends to offer similar average returns. Equity mutual funds often outperform, providing returns slightly above the stock market average. Is stock market investing ideal for short term? It is better suited to long term goals with a minimum horizon of 5 years. The next question arises: what if your time frame is shorter? In that case, fixed deposit or debt instruments would be more appropriate, offering stability without the same level of risk. Next, understanding stock market declines. What do they mean? Ups and downs are a natural part of stock market investing, and those who grasp this reality often reap the rewards. A decline of around 5 to 10% is typically termed as market correction. Why does this happen? It usually occurs when stock prices become overvalued and need to adjust. Market corrections are a regular feature of market cycles. But what if the stock index or a stock's price drop by 20% or more from its peak? That's a bear market. On the flip side, when the market or stock prices rises by 20% or more, it enters a bull market. While the stock market has experienced many significant declines over the years, it has always rebounded stronger. Market dips and comebacks. Timing your next move. When the Indian stock market drops by more than 6%, how long does it take to recover? Research reveals intriguing trends.
After a major decline, the market tends to rise about 12.5% within a week, 17.5% within a month, and approximately 18.5% within a year. So, what does this mean for investors? Do not shy away from investing in quality stocks and funds during a downturn. Here is our final takeaway. Market downturns may seem concerning, but they offer a unique chance for long-term growth. Patience and discipline are essential. Stay focused on your investment strategy and even amid market fluctuations. Rather than fearing market dips, consider them opportunities to acquire quality assets at discounted prices. History shows that recoveries can be rewarding for those who remain consistent in their investment approach. Avoid making decisions based on fear. Sticking to your plan will lead to better outcomes in the long run. A detailed blog post on this topic is available on our website and the link is given in the description.
Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.